Before we get stuck into today's vid, I just want to give a quick shout out. Tamala, one of our Patreon legends, put this topic forward, and it's a bloody important question. So Tamala, this vid's for you and all our Patreon champions, plus anyone who grabbed a copy of the book. You blokes make this channel happen, and I'm dead set grateful to each of you. If you want to back the research and have a say in the next topic, check the link in the description. Alright, let's get into the main event. Richmond, Virginia, September 1863. After finishing his shift at the Confederate War Department, John Bosham Jones headed to the market and jotted down in his diary what he saw. Boots were $100 a pair, regular shoes $60, firewood $40, a cord of wood, a shuck, and a mattress $40. He logged it all real matter-of-fact and methodical. 'Cause that's what a war scribe does. He's noting what he sees, what he saw day in, day out in his diary during the war. A currency dying in plain sight. Jones was inside the Confederate government, so he saw the demands, the print orders, and the memos from the Treasury. He knew full well what was going on and why. He kept writing down the prices anyway. Boots, bread, coffee, coal, and watched the numbers go up like a fever graph. What he went through was the only recorded case of hyperinflation on American soil. The question his diary hints at, the one hidden in every price entry, is the same one this video aims to answer. If hyperinflation hit the US today, how much could fair dinkum Americans actually cop? Not Weimar Germany, not Zimbabwe, not Venezuela, right here, right now. This question's got an answer, and history's got it. First up, let's nail down what we mean by hyperinflation, because the word gets thrown around too casually, and loose talk leads to dodgy thinking. The official line that economist Philip Kagan set back in 1956 is dead simple. Prices going up by 50% or more in 1 month. That ain't the yearly inflation, mate. It's the monthly one. 50% a month works out to about 13,000% a year. So a cup of coffee that set you back $3 in January would be $390 the next January. That's the textbook definition of it, and it's happened 57 times in documented history. The US pops up on that list once. Back during the Civil War, the Confederate States of America was a sovereign government that operated on American soil with American citizens for 4 years. It copped one of the most destructive inflations the Western Hemisphere has ever seen. According to a groundbreaking 1955 study by economist Eugene Leonard, a standardized commodity price index for the Confederacy went from 100 at the start of the war to over 9,200 by the spring of 1865. That's a rise of over 9,000% in 4 years, working out to roughly 26% per month across the whole conflict. Jones noted that boots were going for $60 in late 1863, and in the last months of the war, a barrel of flour set you back $1,500. The Jones family got by on turnips from their backyard veggie patch. The Confederate government pretty much funded the whole war by just printing money. They couldn't raise taxes properly, and they couldn't borrow enough either. So they printed more, and the more they printed, the less each banknote was worth. And the less each note was worth, the more they had to print. Ring any bells? This spiral between creating money and losing trust isn't some ancient or foreign thing. It happened right here on this land with people who called themselves Americans less than 200 years ago. Now we've got the United States of 2026. Before we can work out how much hyperinflation the Yanks could cop, we gotta understand where they're at right now. Here's what the numbers actually say. Not predictions, not theories. What the data actually shows. From January 2021 to early 2026, the Consumer Price Index shot up by more than 25%. All up, this is one of the quickest ongoing price hikes we've seen in donkey's years. Over the same period, nominal wages went up according to the Bureau of Labor Statistics, but they didn't climb as steeply. Real wages, wages adjusted for actual buying power, were in the red the whole time. Come early 2026. The worst single month over that stretch was June 2022, when inflation clocked 9.1% on a yearly basis. With wages only rising 4.8%, that left a gap of over 4 percentage points. Households copped a loss in buying power every month for 25 straight months, until wages finally caught up in May 2023, and even that was just temporary. By the first quarter of 2026, most real wage indicators had dropped again, says the Brookings Institution. Net wages for low-income Americans went up. With only a 1% yearly rise versus inflation at 3%, the gap had yawned open again. Now chuck the household balance sheet on top of that. Credit card debt in the US hit a record $1.28 trillion by the end of 2025, according to the Federal Reserve Bank of New York. That's a massive 63% jump in only 5 years. The personal savings rate crashed to 4% by early 2026. Bank of America Institute reckons, after sitting above 6% 2 years before. Nearly 1 in 4 American households spent over 95% of their income on the bare necessities. Housing, food, utilities, transport, nothing left over, bugger all. That's the starting point, the baseline from which any more inflation shocks would kick off. Now ask yourself how much more they can cop. To answer that, we need to have a squiz at what hyperinflation actually does in a modern, credit-reliant service economy. Because it doesn't look like what happened in the Weimar Republic back in 1923. Most people got paid in cash, most transactions were local, and most tucker came from farms you could get to in a day. The barter system that popped up during the hyperinflation, doctors got paid in firewood, teachers in eggs, and cigarettes became the de facto stable currency, was bloody brutal. But it was doable. The Germans had a fresh memory of a pre-industrial local economy they could fall back on. The United States in 2026 can't do that, because Americans don't get paid in cash, they get paid electronically in dollars. Every fortnight, their rent gets automatically deducted, their car payment gets auto-debited, and their utilities get taken out automatically. Their food comes from a supply chain that stretches across continents and is priced entirely in dollars. There's no informal food economy to switch to, and no local barter level. When German workers in 1923 got paid twice a day so they could spend their wages before prices went up. Again, the system worked because the goods were physically nearby. If you try that in a country where a family's food comes from a distribution center 800 kilometers away, priced daily based on fuel and logistics costs, the maths doesn't add up, and the supply chain collapses before the barter economy can replace it. That's vulnerability number 1, reliance on infrastructure, and vulnerability number 2 is debt. The Confederate citizens of Richmond and Charleston had something in common with the Germans of the Weimar Republic. Most of them didn't have consumer debt in the modern sense. Their financial commitments were pretty simple, and their vulnerability to rising interest rates was limited. American households in 2026 carry on average over $100,000 in total debt per household: mortgages, car loans, and student loans. Credit cards. The average annual credit card interest rates were still over 21% at the start of 2026, when prices start rising fast. The historical response from the Federal Reserve is to keep raising interest rates. Every 1% increase in the base rate raises the cost of servicing that debt for a family already spending 95% of their income on necessities. There's no wiggle room, none at all. Vulnerability number 3 is the dollar's spot in the world, mate. Weimar Germany had the benefit of a clear bottom line. The mark was only used at home. When it did go down, it went down relative to foreign currencies. People with foreign currency could swoop in, snap up cheap German assets, and prop up the economy from the outside. The US doesn't have that same backup because the dollar's the world's reserve currency. Sounds like a strength, but that only lasts till it turns into a liability. That's because the dollar's reserve status means the whole global financial system is priced in dollars. If the dollar starts heading into hyperinflation territory, the damage won't be contained inside the US. It spreads outward. The rest of the world reacts by selling off dollar assets and trimming dollar reserves, which speeds up the collapse instead of softening it. By mid-2026, the dollar's slice of global forex reserves has already dropped from about 71% back in 2001 to roughly 57%. Central banks have been buying more than 1,000 tons of gold every year for 3 years straight. The trend's pretty obvious. The dollar still has massive advantages. It still accounts for more than half of all global transactions through the SWIFT system, and the BRICS mob hasn't come up with a believable alternative. But the safety buffer, the gap between a reserve currency under strain and one in full-blown crisis, is thinner than it's been for ages. The big question is this. History gives us 3 data points on how much inflation a modern civilian population can stomach before the system shatters. The Confederate States copped a total of 0% inflation over 4 years, but it was a wartime economy with no other options. Folks stuck with the system because they had no way out. Confederate banknotes were the only legal currency around. Gold zu horten war echt schwierig. Und trotzdem, am letzten Kriegsjahr, schrieb Mary Chestnut, eine der berühmtesten Tagebuchschreiberinnen der Konföderation. Sie hat niemanden gefunden, der bereit war, Konföderiertengeld für Klamotten zu nehmen. Sie schrieb, wir finden einfach niemanden, so in etwa, Kleidung gegen Konföderiertengeld tauscht. Also essen wir unsere Kleider auf. Die Weimarer Republik ging von Anfang der Hyperinflation Mitte 1922 bis zur Stabilisierung am November 1923, so etwa 18 Monate mit voller Wucht. Die Deutschen haben es ausgehalten, bis sie es nicht mehr konnten. Und die politischen Folgen waren kein frischer Start. Es war das Ende der Weimarer Republik und der Kollaps der deutschen Demokratie und der Aufstieg einer Bewegung, die den Lauf der Menschheitsgeschichte komplett verändert hat. Was ist also die echte Antwort? Wie viel hätten die Amis wohl ausgehalten? Hier kommt die ehrliche Antwort. Es gibt keine Zahl, und das ist keine Ausrede. Das ist das Wichtigste, was uns die Geschichte lehrt. Leute geben eine Währung nicht auf, weil die Inflation einen bestimmten Prozentsatz überschreitet. Sie geben sie auf, weil sie nicht mehr glauben, dass sie morgen noch was wert sein wird. Dieser Glaube oder der Verlust davon bestimmt die Grenze. Nicht die Mathematik, sondern die Psychologie. Have a think about what that actually means, mate. The Weimar mark didn't collapse because inflation hit 322% in a single month, which it did. It collapsed because one morning, in one particular town, enough Germans decided at the same time that the paper in their hands wasn't worth taking anymore. Farmers stopped selling food for it. Shop owners stopped pricing things in that currency. Workers demanded to be paid twice a day so they could spend their wages before the afternoon made them worthless. None of those people made a rational decision based on inflation stats. They looked at their neighbor, and the neighbor looked back, and both knew without a word that the game was up. The Confederate dollar died the same way. Soldiers' families stopped selling food for it even before the war ended. Not because of a government announcement, but because trust quietly dried up, one transaction after another. So the question of how much the Americans could cop really can't be answered in advance. It depends on a moment that's never happened before. A moment when enough Americans decide at once that the dollar they hold today won't buy what they need tomorrow. That moment could come after months of creeping inflation, or it could happen suddenly, triggered by a single bit of news. A failed treasury auction. A bank that doesn't open on a Monday morning. But what the structural evidence tells us is the debt, the automated payments, the reliance on supply chains, the almost non-existent savings mean Americans today have nearly no buffer between that moment and disaster. Earlier populations that went through hyperinflation had time. They had savings to burn through first. They had local food networks to fall back on. They had the friction of physical transactions that slowed down the collapse. By 2026, Americans won't have any of those buffers, mate. So if trust goes, if it does go, it'll break faster than anything history's ever recorded. So the answer's not a number, it's a speed. Hyperinflation doesn't finish when inflation hits some percentage. It ends when people stop accepting the currency, or when a trustworthy substitute comes in. Back in Weimar Germany, that replacement was the Rentenmark, backed by a mortgage over all of Germany's farming and industrial land. In the Confederate South, the substitute was the US dollar, and it was brought in by military force. In today's US, there's no clear answer to what the replacement would be, what actually worked, and that's why you're here. 3 groups got through hyperinflation in the Confederate South, Weimar Germany, and every similar crisis. The records show that understanding these groups isn't just academic, it's practical. First group, folks who held assets that went up in price with inflation. Rather than fighting it, Hugo Stinnes, a German industrialist, borrowed a heap in marks before the inflation cycle hit its peak. He used that borrowed cash to snap up real productive assets, mines, factories, newspapers, shipping lines. When inflation took off, his debts became worthless in real terms, but his assets held their real value. By the early 1920s, he was the richest bloke in Germany, while the middle class got wiped out. This isn't about giving Stinnes a moral thumbs up, it's a documented process. Debts that are in a dying currency and backed by a real asset mean a transfer of wealth from the lender to the borrower in a hyperinflationary situation. Someone with a fixed-rate mortgage owning a block of real land can pay back the loan with dollars that are worth less. The land keeps its buying power. The window to use this strategy is pretty tight. It kicks in early in the inflation cycle, and stops once interest rates shoot up as a reaction. Confederate bonds were flogged off for most of 1861 before inflation went nuts. Inside a year, nobody wanted them. The whole thing crapped out ages before the crisis peaked. The second lot, those in the Confederacy and Weimar Germany who held on to stuff instead of cash. Farmers came through it better than just about anyone else. Not because they were rich, but because they had control over the supply of life's necessities, and could price them in a currency or barter item that held its value. A Confederate farmer, the ones who wouldn't flog their corn for paper cash and insisted on gold, silver, or other goods, they kept their buying power. City workers, on the other hand, ended up in poverty. In a modern American setting, it's a bit different. You won't be a farmer by Tuesday, but the basic idea still stands. Having control over something physical, like food, fuel, water filter gear, tools, medical stuff, that's a kind of wealth that doesn't need any money. In Weimar Germany, cigarettes became a solid currency for trades. Because they were physically scarce, everyone wanted them, and no government could just print more. The principle ain't about cigarettes. The principle is this. What's that one thing in your community that people will always need and that no printing press can make worthless? The third group's the one that gets left out in most history books. They're the ones with skills that couldn't be digitized, outsourced, or replaced back in Weimar Germany. The black market economy that popped up to take over from the wrecked official economy, it ran on skilled workers. That meant mechanics who could fix gear, doctors who could look after people, carpenters, plumbers, and farm workers who knew how to make the important stuff. Their wages in marks became totally useless. Yep, but their knack for swapping skills directly for grub, a roof, or some decent cash meant they got by, while the office workers, bank tellers, and pensioners were left in the lurch. J.B. Jones saw this whole thing play out from smack bang in the middle of Richmond. He was a public servant in the War Department and got paid in Confederate dollars. He watched the buying power of those notes shrivel up with every entry in his diary. By the time the war wrapped up, his family was surviving off whatever their backyard veggie patch could still produce. The real eye-opener that comes from a crisis like this is the bit that's genuinely brand new. American workers in a hyperinflation scenario face a danger that neither the Confederate Southerners nor the Weimar Germans had to deal with on a big scale: automatic debits. Inflation's chugging along at 50% a month, and your rent gets sucked out of your account automatically on the first of every month as a fixed dollar amount. That rent payment gobbles up more and more of your actual buying power. Confederate citizens had to physically hand over paper money to their landlord. They could haggle, they could stall, they could suss out other options. American households in 2026 have their financial commitments set up to automatically transfer fixed dollar amounts straight into their bank accounts on fixed dates. The system doesn't give a toss about hyperinflation. The households in the most strife aren't the poorest. They're already mostly outside the formal automatic banking system. The most vulnerable mob is the average middle-income household. They've built their whole financial life around automatic payments, fixed-rate commitments, and credit card bridging. The only structural protection against the automatic debit trap is owning assets that aren't paper and not having any fixed, dollar-denominated obligations. That can drain you faster than your income can revalue itself. That's a smaller chunk of Americans than most people reckon. The official line these days is that hyperinflation can't happen in the United States because the Fed's got the tools to stop it. The Fed can jack up interest rates, shrink the money supply, and keep its street cred intact. What the actual records show is a bit more complicated than that. The Fed's tools work a treat when inflation's caused by money supply issues, when there's just too much cash floating around. But when you're chasing after too few goods, those tools are blunt, slow, and cost a heap politically. Hiking interest rates smashes borrowers. Cutting the money supply slows down the economy. Both cause plenty of pain before they start to fix things. More importantly, the Fed's credibility relies on the world trusting the dollar. If that trust melts away faster than the Fed can react to a sudden shift in demand for reserve currencies, or if a commodity shock priced in non-dollar currencies hits, or if a loss of confidence triggered by something outside the US comes along, then the Fed's tools just don't work quick enough. The Weimar Reichsbank had its own set of tools too, but they used them too late, under political pressure that stopped them from pushing through the necessary pain. The Confederate Secretary of the Treasury, Christopher Memminger, knew exactly what was happening to the Confederate dollar right from the start of the crisis. He put it down in writing, but he couldn't stop it because there wasn't the political will to raise taxes stop the printing presses, and enforce austerity. The Federal Reserve ain't the Reichsbank. The dollar ain't the Confederate dollar. The differences are real, and they matter. But the gap between what needs to be done and what's politically possible, that's not some unique historical thing. That's just human nature. Historians credit the Rentenmark for ending the Weimar hyperinflation, but the textbooks give the nod to Hjalmar Schacht, the currency commissioner who introduced it. The official story goes that a smart bloke turned up with the right political tool and saved Germany. But what the diaries actually show is a different story. By the end of 1923, before the Rentenmark came in, ordinary Germans had already stopped accepting the mark. In heaps of transactions, barter had taken over the mark across big chunks of the economy. The population pulled their support from the currency even before the authorities gave them the green light. The official yarn is that the government saved the currency. What actually happened is the people buried it. And then the government got the credit for the funeral. That's what you've got to understand about a currency crisis in any country, including this one. It doesn't end when governments act. It ends when enough people stop believing or start believing again. Policy always comes after confidence. The question worth asking today isn't how much hyperinflation the US government can prevent. It's how much the American people can cop before trust runs out. Before I sign off, big thanks for watching and leaving comments. And thanks for sharing these vids with the people in your life who need to see them. The channel grows because of that. And I read every comment and cop every correction. You're the reason this work keeps going. If you want to dive deeper into the question this vid raised, I've got a recommendation. Me and my team have published our first book. It's an adaptation of the world's first economics book, written by Xenophon of Athens back in 362 BC. He was a soldier, a student of Socrates, and a well-off farmer. He knocked up a dialogue about the very same question this video's on: what's real wealth? His answer, over 24 centuries old, holds up better than any central bank policy in the world. Wealth ain't gold stashed away in a vault. True wealth is the ability to get things made. A horse is wealth for a bloke who can ride it. Land is wealth for a fella who knows how to work it. Money by itself ain't wealth if you don't know how to use it. The book's called The Economicus. You can grab it as an ebook, paperback, or audiobook. You'll find the links in the description. It's the very first book ever written on economics. And if you read it now, with what you've just learnt about hyperinflation, you'll get something most economists have forgotten. Thanks for watching, mate.